So like any project, there's a lot of risks. The political risk in one country is much more than in another. You've got to play to your strengths. Labour costs are an issue. I think some of the key ones are the reserve quality. You're really going nowhere if fundamentally your reserves aren't there or the quality is not so good. So you have to hire an independent expert, and there's a few here in the audience. Also, I think these days, management experience, we can't underestimate how managers can make or break companies. I've worked with some companies in the past where the asset is really good and the management has been horrible, and they really just run the company to the ground. So, not only how many years experience, but how many mines they've opened and operated are quite important. You'll notice since the crisis, globally, there's a lot of the big positions in the top mining companies, they've all, there's been a big turnaround. For example, we've had the head of Rio Tinto change, the head of BHP change, the head of Anglo American change, the head of Peabody change. And this was a result because of a lot of shareholders obviously wanting shareholder value. The price has gone down, so someone has to take some of the I don't want to say the blame, but so there's been a large turnaround in the workforce of management. So that's something that I'm very sensitive about these days. The other one is transport. I know I showed you the seaborne coal market, but it really is trying to get this piece of coal to the market. And if it takes you a long time or is expensive to get there, you may not be as competitive. So one advantage is if some of these coal companies actually integrate vertically, and they might actually own their own port facilities or transport facilities. And that's always something good to look at when you're evaluating a company. Okay, so back in 2009, I was quoted here, and I actually said bankers have been more picky on project financing, on investing in projects. And that was in 2009, straight after Lehman's, when I could see things were happening. And here I am, 6-7 years later, and I'm kind of saying the same thing. So here's my question: where have all the bankers gone? But seriously, one thing that's impacted the market is an exodus of banks in the commodity space or the physical trading. And this is just, I don't want to pick on any bank here, but you can see that in the last year or so, a lot of the big banks have actually exited their commodities trading businesses or their physical commodities. For me, it's like an ecosystem. If these guys are out of the picture, then something becomes imbalanced. So this is where I think some of the industry might be suffering. But I still think there are areas where you can get financing, your traditional debt capital markets. I think there's still a large appetite for bonds, international bonds. Project finance, I know there's a few PF bankers here today that obviously well versed, and for a good project with mitigated risks, I think there's still appetite. And I've actually seen a lot of private finance now, so a lot of the guys that are sitting on the sideline, large amounts of money willing to take a view on the market. What lies ahead? I think the coal price will remain under pressure due to oversupply. The Red Queen syndrome I mentioned earlier. There's a little upside at the moment as China's heavily invested in transport infrastructure, bringing down the cost of their production, marginal cost of their production. So some trends. I think the conversion of resources into cash flow, as I mentioned, is key. Equities have been affected by the big macroeconomic events. So, for example, you could be a coal producer in Indonesia and something happens in Greece, and for some reason your share price goes down a few percent. You think nothing really to do with your production, but this is the world we live in. So that's what I mean by equities have been affected by big macroeconomic events. But I think when that happens, that's actually some opportunities do exist, so it's not all negative. I believe we're going to see an increased consolidation on mergers and acquisitions. With the coal price quite low and a lot of these companies trading at relatively low multiples, I think we will see a lot of M&A activity. And also, as we saw, 3 RTOs in the last 12 months, just here on SGX alone, I think we'll see a bit more backdoor listings and reverse takeovers as a way to capitalize on your investments. In terms of Asia, it is all about resources. I think all the supply and the demand dynamics exist here in the region. So the solution is here in Asia as well. And there are opportunities, I think, for selected investments in coal. I think the opportunities are real. And I'm currently working on some of those opportunities. I'd compiled a list that showed what the long-term view of these bankers were. And these are great banks, right? These are all the big banks that you're used to dealing with. And this was done when the coal price was, at that time, the spot price was about $84 a tonne, so about 12 months ago. And they estimated what the long-term coal price would be, which long-term for them is, say, 12 months. So that estimate, comparing it today, which is 12 months later, every single bank got it wrong by a large margin. The lowest was, the most conservative was $95, and some of the guys went up to close to 110. And the average was $95. And the price today is 61. So, back to that herd mentality or anti-contrarian views is all the banks are saying coal price is going up, everyone's excited, and it didn't happen. So these days, being an ex-banker, when everyone tells me, and the bankers tell me it's all going to go up, I think it will go down. So everyone's saying coal price is going down now. So sooner or later, I think with all this cutting back, and I'll leave you with this comment, is coal and oil are really dependent, is energy. So when there's cheap energy, what do? You can actually build things cheaper. A company that needs coal and 30% of their budget is energy, when all of a sudden the coal price goes half, that means only 15% of their budget is. So what's that's going to happen? That means industry now is going to pick up because the energy is so cheap. If I've got an energy-intensive company, this is the time to really start building. So what happens when all these guys start building, at some point they're going to need more energy, which means the demand is going to grow. So eventually coal will come back into favor, and so will oil. So I think it's the good thing about commodities is very cyclical. It doesn't stay bottom forever, and we always overshoot and undershoot the market.
Alberto, particularly in view of a lot of what you just showed us on the slides, seems to say that the coal market is out of favor. Prices come down, there's oversupply. It doesn't paint a terribly rosy picture for the coal industry. How long then before we see that upward cycle again? How long before we see an improvement in the coal price and, in other words, more profits for the mining companies?
Look, I think all the cost cutting is creating some discipline in the market, which we needed. So you may have heard comments that a truck driver in Australia in one of the mines was earning $150,000 US a year. Those kinds of things aren't sustainable. So no, most of those truck drivers aren't around. And I think by the next time the cycle comes, they'll probably start off with a $50,000 salary and increase. So it is very cyclical. I mean, how long? Difficult to tell. I mean, I mentioned at the end how it's all really dependent on industrial growth. When energy is cheap, industry follows. And I'll give you an example. When I was an investment banker, every major Western client was trying to come into Asia for cheap labor and cheaper energy, and set up manufacturing plants, for example, in China or Vietnam. When the US started with the oil shale gas revolution, where gas prices literally halved overnight from $6 and $7 to $2.50 or $3, a lot of manufacturing companies started to set up in the US, which was really interesting because usually you want to go to China because that's cheap, and all of a sudden the US became cheap, which is a very interesting trend. And I think that's what we'll see is the countries that have the cheapest energy are going to start increasing slowly industrial demand and manufacturing, and the coal prices will actually follow. So how long does that take? It doesn't happen overnight, but one thing, we always underestimate the thing. So if I actually say it'll take 18 months, it might actually take 14 or 12 or 8 months. And this is where we've been caught out before. I mean, oil too, people were saying only 3 months ago that oil fundamentals were strong, and now they've dropped incredible, so everyone changes their views. So, it's a very dynamic world, and how long? In the past, when you plot some of these cycles, you can see they're 10, 12-year cycles. Now I think with information and efficiency in markets, these cycles are much shorter. So the peaks and the troughs are sharper, but the cycles, the actual wavelength is actually shorter. So I don't think we're in for a big long haul of 5, 10 years.
Right, and John, you've spent 5 years in Jakarta looking at and servicing coal companies. What's your on-the-ground view then of how these companies are positioning themselves for the next upswing?
I guess the survivors have invested heavily in their cold chain. So that's the biggest thing I've seen, and that's lowered their unit costs to a level where they can actually still survive in this market. And I think they're very well placed for when the economic demand for their product increases. So that's the most obvious trend I've seen in the past couple of years.
And you called it the cold chain. What's that?
The coal transport chain. So that's getting it from the mine. Typically it goes to a mine on a truck, then onto a barge, and then from a barge onto a ship.
Right, and so as the costs of that have come down, it's good for the coal miners, I guess is the point.
That's right. It's they've invested heavily. A lot of people have got conveyors instead of trucks, different type of mining. They might different type of fleet of barges. So it's all those sort of things, and they all add up to a lot lower costs.
It's not that long ago that the ships couldn't get into Newcastle port. Do you remember the stories of these ships laid up just offshore, and the bottleneck getting the coal out of Newcastle was almost like what Chong Lek was describing earlier at the ATM machines. It seems that have these issues actually been resolved?
That's a good question, because now one of the keys about Australians be competitive on the coal curve against, say, Indonesia was the freight differential. It's actually cheaper for coal to be transported from Indonesia into China or into Japan and Korea than it is from Australia. It could be several thousand kilometres more freight. But now the freight costs have become so low that I've seen some reports recently where on an energy basis, some of the Australian freight costs are actually cheaper, because a lot of the Australian coals are actually higher energy value, higher quality coals. So based on an energy basis, value basis, the freight's not too bad. So it is a good time to ship coal, because there's a lot of vessels probably waiting outside Newcastle, but empty ones.
John, what about your experience in Indonesia? Because obviously, being so close to Indonesia, presumably a large number of the companies that over the years we will see here list on the Singapore Exchange have assets just across the water from here. You spent 5 years there. Is the situation as dire there as Alberto is making it out?
It is very bad times at the moment. So basically, the big players have prepared well for it, and I think that they're still making a reasonable margin.
Give us some names. Who are we talking
well,
about?
we're talking about the Adaros. They're doing quite well. KPC is reaping some benefits, but they've got debts. But if you look at them as a operation, they're doing very well. That's right. It's part of the Boomi group. So look, I think it's the small players that are just falling over, and the only new players I've seen, which is exploiting little niches in the market, low CV coals, which are excellent blending coals. There's an appetite for that still in China and India. Very low ash, very low sulfur, and low cost. So a lot of people are looking at developing those sorts of coal assets because, as Alberto said, in Indonesia, it's not far to a ship, and so that's a good incentive. So, it's suffering market, but production is still growing overall, and there's new players exploiting little niches. So it's a bit of a surprise, really, but it's still going forward.
Alberto, I just want to follow up on your comments regarding private equity. you've made the comment that you're seeing a significant increase in the amount of private equity available to invest in coal. I'm curious whether you see that the proportion of investment going into the market as a result of private equity, is that likely to increase in the next couple of years? Is it likely to decrease? And what is it actually tied to? Is it linked to the actual commodity price as opposed to the reluctance of the financial markets to invest in it or not? I'm just curious to see where you see that going.
Okay, so with private equity and private investors, two different things. Private equity is normally some kind of established fund that has a certain mandate with specific parameters to invest in. So they'll say, okay, our parameter is we want to invest in coal, Indonesia, and we want an exit of 3 years. So when you've got those parameters, you have to look for coal projects in Indonesia, of course, and you have to take a view if your exit as an investor, exit means your monetization event, and if you can get out within 3 years. Those guys are back in full force. Post Lehman's, they all just got obliterated and lost a lot of money. All those equity, their amounts got eroded severely. A lot of the private equity guys are in full force. Then there's private investors who are a bit different. They're different to private equity guys. Private investors would be like high net worth individuals who, it depends on the individual, but usually they take a longer term strategic view. So they might actually know the CEO of the company or have some view, and they'll just inject funds in or investments at a particular level and probably take a longer term view. They won't be so cut and dry on we need to exit within 3 years. So there's those two types of private pools.
In particular, I'm curious about private equity rather than the longer term investors, because as you've said, they've generally got a time frame, maybe 3, maybe 5 years. They must therefore have a view on the commodity prices, and that exit strategy presumably is linked to that.
Okay, the biggest problem with private equity is they typically take a 3 to 5 year exit view, and if you invest in an early stage project, the actual, and you're a geologist, so you know, how long does it take from an idea to production? Typically it can take 10 years, right? Well, let's say we've been aggressive and from idea to production is 3 years. These guys are very close to their exit by the time you get 3 years, which is your first production, so you've only got about 1 or 2 years of cash flow. So not much of a track record to then sell off at a high multiple. Although when you see my chart about the MPV graph, I think you can sort of pick where would be a good time to sell. So that's the problem with private equity. Private equity guys say, we've got a lot of cash, we want to invest here, but they need a 3 to 5 year exit. And in mining, 3 to 5 years, as you know, is not a long time. You know, you could be waiting for a permit for about 1.5 years. So the PE guys start to get a bit sensitive about those kind of issues.